Hello, investors, and welcome to Stock AI Insights. Today is February 5th, 2026, and we're here with a quick overview of today's key news in the U.S. stock market. Get this, the market is getting hammered by the very same technology it's betting its entire future on. Now, just a quick reminder, the content in this program is for educational reference only. It's not investment advice.
Okay, let's dive right in. And wow, it was a brutal session out there. The major indexes closed sharply lower for the third day in a row. The Dow shed nearly 600 points, and with today's 1.2% drop, the S&P 500 is now officially in the red for the year.
The sell-off was pretty much everywhere, but the real story here is this fascinating paradox that's brewing in the tech sector. And that brings us to our first section.
What we saw today was just a comprehensive pullback. Investors were shedding risk across the board. You could really feel the anxiety, and honestly, very few corners of the market were spared.
Now this slide, this tells the story of investor fear perfectly. Out of all 11 S&P sectors, only one, the defensive consumer staples sector, finished in the green. Think about that. When the only money flowing is into companies that sell things like toothpaste and soda, it is a crystal clear sign that investors are bracing for some serious turbulence. So what exactly drove all this anxiety? Well, let's move into our stock spotlight and see how this whole thing is building around a central conflict in the world of artificial intelligence. So here's the crucial point. Wall Street absolutely loves the idea of AI, but it is getting terrified by the price tag. This isn't just some gradual investment anymore. We are watching an all-out arms race, and it's being triggered by these next-generation models that require an almost unimaginable leap in computing power. To even compete, companies have to write these enormous multi-hundred-billion-dollar checks, and they have to do it right now.
And this slide just brilliantly illustrates the Great Divide. On one side, you have the AI spenders, companies like Google and Amazon. Their stocks are getting hammered because, well, they're the ones footing the bill. And then on the other side, you've got the suppliers of all that AI hardware. Think NVIDIA and Broadcom, who are the clear winners today because they're the ones cashing those massive checks.
Take Alphabet, for instance. Even after they posted a strong earnings report, the company announced plans to nearly double its capital spending on AI infrastructure. And the result? The stock dropped almost 3%, wiping out billions in market value.
Amazon's story was even more dramatic. The stock fell over 3% during the day, and then, get this, it tumbled another 10% in after-hours trading. So what was the culprit? A forecast for up to $200 billion in spending that just completely blindsided Wall Street and totally overshadowed their record revenue.
Now, this fear over massive spending, it had a ripple effect. It created a market with absolutely zero tolerance for any kind of bad news. It wasn't just the AI giants feeling the heat. Poor earnings reports elsewhere led to some just brutal individual stock collapses. I mean, look at Peloton. Shares plummeted a staggering 28%. The company just flat out missed on revenue and, maybe more importantly, they gave a really weak outlook for the year ahead, pretty much telling investors the big turnaround isn't coming as quickly as they'd hoped. Another major casualty today was the cosmetics giant Estee Lauder, which really just saw its stock take a nosedive.
And this one's a real head-scratcher. The company actually beat expectations and even raised its outlook for the year. So why the 19% drop? Well, in a nervous market like today's, investors completely ignored the good news, and they focused only on a previously mentioned $100 million tariff hit. They sold first and asked questions later. And over in the chip space, a key supplier for the smartphone industry, Qualcomm, faced some pretty significant headwinds.
The stock sank 8.5% after its forecast for the current quarter just fell short of what everyone was expecting. The company pointed to a tightening supply of memory components, and that sparked some serious worries about the health of the entire smartphone market. And this risk-off feeling wasn't just contained to stocks. Oh no, it spread like wildfire, hitting other asset classes hard. Bitcoin has lost about 25% of its value this week alone, and precious metals also took a dive, with silver plunging 13% just today.
And as if all the earnings drama wasn't enough, some pretty worrying signs from the U.S. economy came in and just added fuel to the fire.
We got several key indicators today that suggest the labor market, which has been remarkably resilient for so long, is now cooling off. And it's doing so very, very rapidly. And that, of course, has massive implications for the economy.
First up, initial claims for unemployment benefits came in at 231,000. That is significantly higher than the 212,000 that economists had estimated. This is a real-time signal that more people are losing their jobs week to week.
Second, and this one is perhaps more concerning, U.S. employers announced over 108,000 job cuts just last month. Now, this isn't just a small weekly tick-up. This is a major signal of corporate cost-cutting. And to really put that number into perspective for you, that is the highest level for a January since the depths of the financial crisis back in 2009. I mean, let that sink in for a moment. That date isn't just a random data point. It raises serious questions about consumer strength and the potential for a much broader economic slowdown, a truly sobering statistic. So, given this whole backdrop of fear, this massive AI spending spree, and all this economic uncertainty, how should an investor even begin to think about the path forward? Well, today's action seems to point towards a few potential playbooks. The first one is to focus on the suppliers, the clear winners from all this AI spending. The second is to maybe rotate towards those defensive sectors, like consumer staples, that actually showed some resilience today. And finally, for those of you with a longer-term view, this sell-off could be creating some real bargain opportunities in quality tech names that have just been punished. My AI analyst verdict? The AI theme is absolutely here to stay, but the market is now fiercely debating the price of admission. What are your thoughts? Share them in the comments. Thanks for watching, and we'll see you next episode.